Hello and welcome to Ticker Tapes. It's Wednesday, which means it's time for a look at the crypto space. Regulators around the globe have been flexing their muscles over the last week. In South Korea, authorities have asked Interpol to issue a red notice to prevent the founder of the now defunct Terra Luna ecosystem, Do Kwon, from avoiding extradition. A red notice is a request to law enforcement around the world to find and provisionally arrest the subject of the individual in question. Terra Luna failed spectacularly earlier this year with the loss of more than $80 billion of investors' money. The collapse sparked a sell-off in the wider crypto markets, which wiped out a significant chunk of their value. South Korean prosecutors have been unable to contact or locate Kwon in recent days and now believe him to be on the run and therefore unlikely to appear before them for questioning. The authorities had previously seized the passports of former Terra Luna employees in Korea. Kwon was last thought to be in Singapore and had recently denied that he was avoiding the Korean government and its officials, saying he had nothing to hide. FTX is one of the world's largest crypto exchange operators and investors, however, that hasn't cut any ice with regulators in the UK who have warned Brits to avoid dealing with the company. The Financial Conduct Authority, or FCA, said on Friday that FTX had promoted its platform and services in the UK without its consent. In an official statement, the regulators noted that almost all firms and individuals offering, promoting, or selling financial services or products in the UK have to be authorized or registered by us, and that this firm is not authorized by us and is targeting people in the UK who are unlikely to get their money back if things go wrong. Ethereum's merge was completed successfully, and its blockchain is now working on a proof-of-stake protocol. This means that its energy use has fallen by some 99% compared to its proof-of-work consumption. However, that's where the good news finishes, because Ethereum has fallen by 16% over the last week and by almost 20% over the last month. In early August, we reported that institutional investors were taking substantial bets against the price of Ether, which at that point had just had a 41% move higher over the prior month. Investment bank JP Morgan said then that anticipation of the merger was a sizable force behind Ethereum's move higher. However, research house Glassnode warned that institutional and professional traders were shorting Ethereum and were positioning themselves to take advantage of a post-merger price fall. In other words, they were buying the rumor and selling the fact, a strategy that looks to have been highly profitable for them. Ether is a different beast post-merger, as Citigroup highlighted in research this week that flagged the 4.5% yield that is now available in the coin via staking, as well as the sharp reduction in the number of tokens issued annually because miners are no longer rewarded for their efforts. That means that approximately 600,000 Ether will be issued each year compared to the 4.9 million issued under the proof-of-work system.